You're watching Capital Cause, and my name is Danny, and today's guest is retired wealth manager Clive Thompson. Clive, thank you so much for making time to come on the show, my friend.
Danny, thank you very much for having me. It's been a tumultuous week, hasn't it, last week?
Yeah, definitely. It's certainly been a week to witness and one to remember, but there's still a lot of haziness as to whether or not we're really out of the woods quite yet. It seems like the market's rallying now. Are we our happy days back here again, Clive, or is there something more on the horizon that we should be aware of in terms of the market? Is it greener pastures from here on out, or not really?
Can I call Mr. Trump and ask him? Because he's the only one who actually knows the answer to
Yeah.
this.
Oh, I mean, if you can, go ahead.
If he knows the answer at all, I really don't know. But we've had this last week. We had this flip flop. The tariffs are on, the tariffs are off, the tariffs are on. Maybe we're going to delay them 90 days. No, we're not going to delay them 90 days. Tariffs are on again. Tariffs are delayed. And then suddenly now they're releasing they're getting rid of the tariffs on the mobile phones and computers. So stocks which are affected by this on-off news are swinging around wildly. And of course, if you know what's going to happen in advance, and I'm sure as hell that I don't, but if you know what's going to happen in advance and you have a lot of money to play with, you can get yourself quite a lot. You can become very, very rich, especially if you're using some form of leverage like options or futures. You have to wonder if anyone did manage to guess it correctly, or better, no.
I believe a few members of Congress just so happened to nail it there. As is usually the case. Like, these Congress people are very astute investors.
Well, whether there was any insider trading there, I think it'd be very, very hard to prove. And as given their positions, I don't think they're in danger. But yeah, you've got to realize when you're an investor, I think really you've got to be a long-term investor, and therefore you're not swung around by the actions of others so much. Obviously, your price will go up and it go down, but it evens out over time. If you're a short-term trader, inevitably, there's always going to be someone out there who knows something that you don't know.
Right. And that should be, I mean, this is the entire premise of technical analysis, right? Is that you should be able to see the smart money accumulate in these stock patterns. Is that not the case?
To tell the truth, I've studied technical analysis. Well, it was many, many decades ago. It was actually from 1985 to 1990. And I spent almost all my time trying to do this, all my spare time, and trying to prove that technical analysis works. And what I could prove is that it does work in 30% of the time, or 33% of the time. And 33% of the time, it does the exact opposite. 33% of the time, it does nothing at all. And you're probably wondering about the last 1%. Well, we're dead and gone by the last 1%. So my conclusion, and this is just my conclusion, it doesn't mean to say that technical analysis is rubbish, and I'm going to come to that in a second. But my conclusion is, if you're looking at that alone and you have no other information to go on, I couldn't make it work for myself. But obviously, there always is other information to go on. So as an example, if you know about some situation, you can then use technical analysis to confirm if your opinion is the right one. So the example I like to use is, if I'm looking at some earnings results or a quarterly earnings call or some announcement which has been made about a merger, I'll try and reach my conclusion it's good or it's bad for the company. Let's say I've reached the conclusion this is attractive, I should buy the shares. Well, I can then go and look and see how they're behaving compared with the rest of the market. If they're going up relative to the rest of the market, they're outperforming the market, it obviously means that a lot of people agree with me. And in general, I'd say that's a good thing, because I must have got it right. If the shares are doing the opposite of what I think they should be doing, well, I've got two possible ways of looking at it. One, I can say, maybe my analysis is wrong, and I should go and have another look at it, because people don't seem to agree with me. Or maybe everybody else is an idiot and I'm the only one who knows what's going on. Now, that would be very vain, so I probably wouldn't do the latter. But in those circumstances, technical analysis can perhaps, in certain situations, confirm what you personally believe based on other factors. But on its own, I can't. Otherwise, if it worked, there'd be computers out there, AI computers, doing nothing but technical analysis and trading 24 hours a day, 365 days a year, and making tons of money with this technical analysis.
Right. But if you were to assume, and this is a big assumption, that conditions are to remain as they are, how do you view the market from here on out? Are we in oversold territory? Where exactly are we right now?
So we've had a very, very long period of high growth in the equity market up until very recently, driven by the technology stocks, the Mag 7, as some people like to know it. And those stocks have, in my opinion, become very well priced. Now, I'm not saying they aren't wonderful companies with fantastic growth opportunities ahead of them, and lots of opportunities in many cases, but the reality is the price you have to pay for what you're getting in terms of future growth has become quite high. It's higher than it was because these share prices have been growing faster than analysts have been raising their forecasts. So we're across the board at relatively high multiples. I mean, I don't want to say they're extreme. They're not extreme. It's not like 1999 when we were absolutely at very, very extreme valuations. So I'm not excluding that they can't carry on up. But we've had this wobble over the last few weeks where at one point we were down nearly 20% on NASDAQ, 15% nearly on S&P 500, and we're certainly down across the board, something like 10% now. They've had a nice bounce. And then the question is that a dead cat bounce, or have we seen the worst? In my opinion, because they still remain quite highly valued, there's a lot of people who are saying, I should have sold at the top. And I think there's probably a lot of people waiting for that top to do what they should have done and didn't do. And Therefore, I think we're kind of capped. And if we're kind of capped, that means that it's going to struggle to break out to new highs, I think. And I think, therefore, if it can't go higher, it has to go lower. So on the balance of probabilities, and this is not technical analysis, this is me speaking from what I feel in my bones, I think we're a little bit too high. I think we will go lower. I don't know. I don't want to say how much lower because you never know. There could be some. I mean, we will get some more news, won't we, on the tariffs and all kinds of things. So more news means more volatility. But in all probability, even with positive news, there's a limit to how much it could go up at the moment, and I think it's more likely to therefore go down. So yeah. Bear market, I would say, is coming. We're not in a bear market yet, but it's coming, in my opinion.
And what about the bond market? The bond market was going down, or the bond yields were going down in conjunction with the stock market last week. Somewhere until the middle of the week or so, they started moving back up again. They crashed down below 4%, and they hovered around 4.3, 4.4%, and that's pretty much where they've been since. And Trump's in the process of all of this, Trump has reversed the tariff. He's enacted this 90-day pause. He's given these exemptions towards electronics and things like smartphones, etc. But the 10-year yield, the US 10-year yield, has pretty much stayed constant since then, as if to say, whatever's going on outside, i.e. the exogenous events through the tariff wars and everything else, is not predictive of bond yields. What do you make of this interesting movement in the bond market? And then you also have a sell-off in the DXY as well. And so that effectively means a higher euro and yen, and a lower US dollar. So go ahead.
So when stocks fall, the usual direction of travel is towards safe treasuries. And when that was happening last week, we didn't see a positive move into treasuries because the yield on treasuries, as you said, went from something like 3.8, 3.9 to 4.5 at one point, 4.3, 4.4 at the moment. So one would have expected the yield on treasuries to be falling as the stock market was falling and stay down because the stock market is still down. But where we are is the yields on treasuries are up when they should be down. So someone out there was selling treasuries, or let's put it another way, not buying treasuries, which is the normal behavior. So I think maybe there were a couple of things going on here. First of all, if we take the international sellers, these are people outside the USA selling US stocks. For once, or for a change, they didn't feel comfortable leaving the proceeds of the sales in dollars. And for safety reasons, they felt they'd feel more comfortable bringing the money home. So that would explain the fall in the dollar and lack of international buying from investors of the treasuries. But there may be also something else going on there, and that would be perhaps with foreign central banks. There's been some quite aggressive talk from the USA about things like, you've been cheating us all these years by selling us your goods too cheaply, causing our poor Americans to lose their jobs and so forth. And it's payback. And we've given you defense of Europe, and obviously everyone's very grateful for that. But it's now payback time. So I think to some extent, countries around the world are almost expecting to be asked to make some heavy concessions to the United States. And one of those concessions might well be a requirement by the USA to invest in treasuries, and possibly, and it has been mooted, by the way, in 100-year treasuries at a low interest rate, perhaps repayable in gold in 100 years' time. Now, I'm not sure what other people think of a treasury bond with a low interest rate payable in 100 years' time, what they think. I would think I wouldn't be very happy about the promise to pay me back in 100 years' time. But perhaps a government can think about it in a different way. But the real point here is, if you have a lot of 10-year treasuries yielding 4.5%, and you're now being asked to change all of that into 100-year treasuries at 1% or whatever the rate is, you're not quite getting the same deal. So maybe you don't want to have so many treasuries, just in case. You want to spread out your risk a little bit because you don't know what's going to happen next week. And you maybe want some European bonds, some bonds from the ECB, some British gilts. And by the way, the bonds in Europe, Japan, Switzerland, and UK were not behaving in the same way as American bonds. In other words, American bonds were going down or the yields were going up. This was not happening. I mean, the yields were going up and down, but they weren't changing overall in Europe. So it wasn't, often bond markets around the world move in tandem. So this was kind of an American move, if you like, for the US bond market. So I think what may be happening is some central banks are quietly letting some of the bonds they've got mature and not necessarily reinvesting them back into treasuries. That could be something which is going on. I mean, we've got another thing which I should put on the table. We are in a debt ceiling at the moment. From the 3rd of January, the US government reached their debt ceiling and they cannot increase the level of debt. So the debt is not going up. There is no new issuance. The only issuance we're seeing is the rollover of maturing debt. So the bond movements, which we're seeing, higher yields or lower yields or whatever it is, have got nothing to do with the funding requirement of the United States at the moment, because what they're doing to pay the bills, they're running down cash balances, and they are not paying money into the pension plans and things like that to make ends meet. And they will probably in August run out of options to pay the bills. So I expect that before we get to August, there will be a lot of debate about raising the debt ceiling, and then ultimately they will raise it. Often in the past, they've raised it at the 11th hour, just before they're about to default. And I don't think they're going to default, but this is what's happened in the past. So we must expect the same thing going forwards. But when they raise the debt ceiling again, it'll be time to refill the coffers. That's the moment at which the government is going to have to go into the market and borrow hundreds of billions of dollars, maybe trillions, to refill the coffers, make the pension plans whole again, which they will. And what they will need at that moment in time is buyers of those Treasury bonds, because there are going to be more Treasuries issued after August. Let's say, I'm saying it could be earlier than that, but when it comes, there's going to be more Treasuries issued. So there needs someone out there to buy those bonds. Now, who are those buyers going to be? Well, that remains to be seen. It looks like there is not a huge amount of enthusiasm from nations outside the United States.
What about Wall Street? What if they deregulate Wall Street to buy in?
Well, obviously there's things which can be done to incentivize all kinds of people to buy. I mean, we can bring regulations for the pension funds, requiring them to hold less equities and more bonds. They could, they could potentially press gang the foreign nations into buying more treasuries. Along the lines of, you want some relief on the tariffs. Well, show us what you can do with the treasuries. We don't like the fact your treasuries haven't risen. We've got more treasuries to sell, and you haven't bought them. So buy the treasuries, and then we'll discuss. So these are, we don't know which way it will play, but there's a risk that the yield on treasuries might start to rise. It has risen a little bit, but it might start to rise some more once they get back to needing to fund themselves. And if there's reluctance or no buying by foreign nations, then we could get to a situation where the yields are rising to unacceptable levels. Unacceptable, we don't know what that level would be, but a lot of people are saying maybe it's 5% is where the cutoff point is, and we're at 4.3, 4.4 at the moment.
Right. And also, I mean, you have this, $8 trillion rollover in the U.S. debt coming due soon. How do you anticipate them refinancing that at 4.5% now? I mean, pretty much that debt was at near zero at the time.
Yeah. So a lot of that debt was taken out at times of when interest rates were close to zero, and so they will have borrowed the money at 1 or 2 or 3%, probably not as much as that. The lowest level you can borrow money as a government today in the USA, it doesn't matter whether you're at 3 months or all the way out to 30 years, is 4-point-something%. So all the interest rates of all periods have got a 4 in front of them, and most of the maturing debt will have probably a 1 or a 2 or potentially a 3 in front. So what it does mean is that as this debt matures, the interest expense will start to rise. I mean, it is rising already. It has, because this is not new. This is not new from next week. This has been going on since they started raising the interest rates 2 years ago. So they put it up to 5.5 at one point. Now it's 4.5 or something like that. So the trouble, so unless interest rates come down very sharply, not only at the short end but at the long end, the government is going to find that the interest expense will be rising. And I did a little exercise, I put it up on my LinkedIn page this morning, about what it would cost the government as a percentage of GDP if all of the debt was at the 10-year yield. So just to step back a little bit, about 2 or 3 years ago, Janet Yellen was saying that the level of government debt at the present level then is manageable if it rises only in line with GDP, and that the interest cost, which at the time was about 1.8%, with a little bit of budget cuts, it might be possible to get the interest cost down to 1% of GDP. Well, the forecast from the Congressional Budget Office for 2025 is that the interest cost will be a lot more than that 1% that she hoped for. It'll be 3.2% in 2025. That's the Congressional Budget Office's forecast. That's 3.2% of GDP, not 3.2% interest rate. But if all of that debt was refinanced at the 10-year yield that we have today, the cost would be higher than 5% of GDP. So what we're seeing, and that would be, by the way, just to put it in perspective, the highest ever cost as a percentage of GDP in all of history. So what we've got is a situation that no matter what they do, unless there's some magic to bring those interest rates down, that interest cost is going to bite deeper and deeper into the GDP and the tax take of America. Now, there are obviously lots of things which could be considered, maybe one thing, maybe lots of small things, maybe some big things, which might solve the problem. And I'm sure that the policymakers, the Federal Reserve, or the Treasury, and lots of other people are looking at all the options and seeing what they can do. So it's not necessarily the end of the world, but if nothing was to happen, of course, we're going to end up with Armageddon in the bond market and Armageddon in the currency market. The currency is going to fail. Now, that's not going to happen. So I'm not saying that's going to happen. I really don't want people to think that I'm a doomsday thing, because the politicians, the experts will be looking for solutions, and they're going to find solutions. The solutions might be painful.
Would that be an artifact of them just monetizing the debt? I mean, the collapse of the currency.
That's one of many options open to them. So the way they would, or one of the ways they could do this, is to take the gold that they have, and if you revalue it at a certain level, could be the market price today, or it could be a price much, much higher than that. But if you remonetize the gold, and don't forget the gold is owned by the Treasury, that's the government, not by the Federal Reserve. The Federal Reserve has gold certificates, which are only repayable at the gold price when they got them, i.e. it's repayable in dollars, not in gold, and it's not linked to the gold price. So the Treasury's got the gold. So what they can do is pass an act to say the gold price, the official gold price is now whatever they want to say, 4,000, 3,500, whatever they want. Then they would sell that gold to the Federal Reserve, maybe by an intermediary, but they sell it to the Federal Reserve at that value, and the Federal Reserve has to take it. They get in exchange newly printed dollars that the Federal Reserve has just printed off the printing press, obviously electronic dollars, which means from the government's point of view at that moment, and I'll talk about what happens next, but from the government's point of view, they got a lot of money in the coffers that they didn't have yesterday, which means they don't need to borrow so much, which means they can spend more. And also, because they made this huge profit on the gold, their budget deficit, or the deficit for the current year, is much, much less. But what's stage two? Of course, they're not going to leave the gold with the Federal Reserve. They gave up on that on the 31st of January 1934, when they took the gold off the Federal Reserve and paid them $35 an ounce for it. In cash with the gold notes. So
what would gold have to be, before you get to stage two really quick, what would gold have to be revalued at to elicit events like this unfolding?
It depends how you do the maths. It depends whether you say we want to cover the money supply, whether we want to cover the debt, whether we want to cover part of the debt. You can find any figure you like up into the hundreds of thousands. And it all depends on whether the gold is in fact redeemable by the public or by foreign nations, because it's all very you can put a price on the gold if in fact you can't go to the, which is way lower than the current price, if in fact you can't go to the government and say give me some. But at a certain level, people will say to the government, let's say it's $5,000. On day one, there'll be a rush of people saying, here's my gold, give me my $5,000. So they'll collect a lot more gold, which obviously is, from a government point of view, a good thing, because where are they collecting the gold from? They're collecting the gold with they're swapping paper for dollars. What a great deal. Print paper and get something tangible. But let's talk about stage two. They've sold the gold to the Federal Reserve at market value. The next step is for the Treasury to take it back. And the way you do that is exactly what they did in 1934. On the 31st of January, it's the same trick. You basically passed a bit of legislation to say that the Federal Reserve sells it back to you at the same price. But instead of paying them with cash or Treasury bonds, you pay them with gold certificates, which is what they did last time. And that's not part of your debt. That's basically a gold certificate. It says, you've given us gold, and here's your gold certificate, $4,000 an ounce. But it's not going to count as part of the national debt, because the Federal Reserve won't be able to cash that in ever.
I see.
So that would create a big surplus in the year in which they do it. And then, of course, they could repeat the trick in subsequent years. If they do it this year at 4,000, next year they could do it at 8,000 if they want.
Which would be repeatable. Interesting. Now that we're on the topic of gold, let's get your view on what's transpiring in the gold market. Before we hit record, you and I were talking about how gold was fairly resilient throughout all of last week. We did see a little bit of a sell-off, but on a relative basis, it held off fairly well. You could say the same for silver, but to a much lesser degree, though. Gold is right now at I believe at a close, if not at all-time high, then close to an all-time high. At 32.34. A little bit dyslexic this morning. 32.34, and silver's at a $32 handle. What do you make of the current price action in gold and silver?
Well, they are obviously different, and there's different dynamics happening behind them. The one which has got the powerhouse behind it is the gold price. What we've observed is when the market sold off by up to 20% at one point, gold was off a little bit, but it wasn't. I mean, in dollar terms, it sounded like a lot. It was off $150 something, but in percentage terms, relative to the stock market, it was almost nothing. And then the minute the stock market started to recover, gold turned on a sixpence and rocketed up to another all-time high. So gold is proving it has a huge amount of resilience here. And what we can see is that despite everything which is going on with lower inflation, the interest rate environment, someone is out there buying gold. And we got a sense of what's happening because gold has been flowing out of London into New York, being converted into 100 on the way before it gets to New York, before it gets to COMEX, being converted into 100-gram bars, which is what's deliverable on COMEX, and it is being delivered. How do we know it's being delivered? Well, you look at the COMEX deliveries, and you will see that we have, once again, record deliveries, and it's like 3 times normal for the month, and we're only 11 days into the month already, and it's 3 times normal. So these are delivery notices. So and the same was true in February. We had record delivery in February. It was 3 times a year ago, delivery notices and already 11 days into April, we're 3 times deliveries. So someone is taking delivery of those expensive 100-ounce bars, which are worth $300 and something thousand each. We don't know who it is. We can speculate who it is. There's lots of potential candidates. It could be some big hedge funds acquiring physical gold. It could be, I've speculated maybe I haven't speculated. Some people have speculated that perhaps the US government itself is acquiring gold ahead of a revaluation of gold to a higher level. Or maybe they're replacing the bars that some people allege are not in the vaults. I mean, I think that's too much of a conspiracy theory for my liking, but one has to accept it's a possibility. Another possibility, of course, is that there are some nations which don't have enough gold and are acquiring it through COMEX. It's difficult to see who would be doing that because I don't see why they wouldn't acquire that gold through London if they wanted to acquire the gold. Why have it shipped to New York and then use COMEX? So I don't think it's China or anybody, but it might be somebody close to America like Mexico or Canada. Now, Canada's got no gold at all, according to the official numbers. But as we know, there's been some very aggressive words used between politicians on both sides of the fence Canadians love Americans love Canadians normally in a certain sense. One would think of them as allies in a way, but when it comes to the trade, it seems they're not best friends at all. And so maybe Canada is saying, well, what are we doing holding all these treasuries? Don't we want to be a bit more diversified? Oh, look, we're the only country who's got only Western country with no gold. Of course, it's in the ground, but that's not where you need it. Maybe we should have some gold just in case. So perhaps Canada's a buyer. Maybe it's, you never know. It might be Berkshire Hathaway. We don't know. They've got the money and they may be acquiring some gold on the side. They did say in the last annual report that the USA has come to the edge and that bonds are not really worth investing in anymore. And yet at that 31st of December, they had this huge cash hoard, which kind of seems to be contrary to what Yeah, seems to be contrary to what they're saying. So maybe since the annual report, a little bit of gold has moved in the direction of gold. We don't know. We don't know. I mean, it's not what they used to say, because they used to say they want to buy businesses which are productive, but I don't exclude it myself.
But it's not just London that the gold is moving out of; it's also the Swiss vaults as well, right?
Yeah, I mean that is true, but a lot of what you see coming out of Switzerland is coming into Switzerland to be refined. So it comes in, gets refined, and then sent out to other countries. So Switzerland's very well, one of the big exports of Switzerland, of course, is gold. But they're exporting what they've imported, because Switzerland has got all the many fine refiners in Switzerland. So the bars might well go from London, the 400-ounce bar from London to Switzerland to one of the refiners, and then be exported from Switzerland to New York as 100-ounce bars, because that's what's needed in New York.
Well, how's the overall health over there in Europe? Because I've been, we've seen this transfer from demand from the US dollar to the euro for once. I mean, this is usually we've been seeing the opposite, but it seems like Europe's market's been strengthening, particularly the defense contractors stocks over there in Europe. But how is the overall makeup right there in Europe? Does the European banking system is that holding up fairly well? I mean, European banking stocks are up, but what does that spell for the rest of the economic health there in Europe? Because I know you're obviously in Switzerland, so I want to get your insights there.
I don't really have any great insight on the banking sector. Of course, like the banking sector in all parts of the world, it is vulnerable to an economic downturn. But the capital ratios of banks in Europe, and I suppose in America as well, has been strengthened massively by regulation. And therefore, the regulators, at least, will tell you the risks that we were running in 2008 aren't there anymore, because the banks have got far more reserves and so forth. So I don't know whether to believe that or not. I mean, obviously it's true they've got more reserves, but it doesn't mean to say they're completely immune from a run on the banks, and suddenly everybody would like to have their money back, and all their money's tied up in long-term loans on mortgages and things like that. I'm not pretending that it's safe, but to relativize it, there's no particular scares at the moment. And in terms of businesses in Europe, the words I'm hearing from those companies I'm looking at, and not a lot have said a lot, but those who are saying things are, I'd call it they're trying to look on the bright side. Now, that doesn't mean to say they're not very disappointed by the fact they'll have less exports to the United States. But in most cases, they try to relativize that by saying only, and then some number, X% of our exports are to the United States. And then reading between the lines, because they won't say this, but let's say the number was 15% of their exports to the United States. Reading between the lines, you'd say, okay, well, perhaps they'll lose half of that, so it's only 7.5%. But then what they will say is, we're hoping to do more business with our partners around the world. And so you're thinking, well, if they lost half the business to America, they've got to recover 7.5%. They might be able to sell that 7.5 to the rest of the world, but they won't be able to sell it for the same price. They can perhaps only sell it for 5.5, so they lose 2%. So their profits will be lower, but it's maybe in most cases not dramatically lower, but lower. And that obviously has an impact on share prices too.
Understood. I think that's all I got for today here, Clive. Anything else you want to talk about before we sign off here?
Well, the only comment I make, Danny, is I started my own YouTube channel 2 days ago. So if people want to look me up, they'll probably find me by Googling with a bit of luck. I don't know if you don't.
We'll post a link down below for sure.
Oh, that's great. And I'm mostly talking about stocks. In that I'm giving guidance on how to buy and sell shares, guidance on price earnings ratios, guidance on momentum trading, guidance on different investment styles like dividend style, And in each video, although I talk about what most of your listeners will already know, you're bearing in mind your listeners are very intelligent people, Danny, so they might know what I'm talking about at the beginning. But at the end, I always try to have a little tidbit which they may not know, which could give them an edge in their investing if they're buying stocks and shares on the stock market.
Excellent. Well, I'll have to subscribe as well then to unlock some of those secrets. But we'll for sure have we'll have the link down below to Clive's YouTube channel. Be sure to subscribe, guys. I know you also have a LinkedIn. Do you want us to share that as well?
Sure. I mean, I'm on LinkedIn daily. I'm writing articles 2 or 3 times a week, and I get a lot of questions coming to me as a result of these YouTube shows I do. I don't give investment advice as such, but I try to help those who are interested, who have questions, see if they're on the right road. Sometimes people have come into a lot of cash from a house sale, or they've got some exposure to a particular sector of the market, and they're wondering if they're mad. And so I try and help them see the way forwards, rather than saying you must do this or you must do that, or you should do this or should do that. If someone comes to me and says I'm 100% invested in gold, do you think I should leverage up now? Well, I'm going to try and make them understand they've probably got too much in one pot. But if they are 18 years old and they're 100% invested in gold, well, great. It all depends on the circumstances. If I could have my time again, I would say the way to invest money is you should have the number of investments which equal your age minus 20. So if you're 21, you should have 1 investment, and it should be the one you have the strongest possible belief in. If you're 25, you should have 5 investments. And by the time you reach 65, you're going to have 45 investments. So you're very diversified.
Interesting methodology. I'll have to, see if I can apply that to my circumstance as well. A wealth of knowledge is always here, Clive. Thank you so much for your time, guys. If you enjoyed this podcast, be sure to drop us a like and also drop us a comment. Right? Go, Clive, go in the comment section. Also, subscribe to the channel if you haven't already. We do get a boost in the algorithms when you do so, and it's an easy way to support me. Nonetheless, it's free and it takes less than a second to do so. So if you're getting value out of this, much appreciated if you hit that like and subscribe. Also comment down below. Check out our good partners over at Capitalist Exploits. It's my #1 newsletter. I've been using them for over 5 years now, and I can't recommend them enough. We have a special $1,000 discount for viewers of this channel. And the way I kind of like to look at it is if you're the CEO of your portfolio, then Capitalist Exploits is kind of like your outsourced research team. So check out the link down below. Look at all the offerings. I can't recommend it highly enough. And then also check out our Substack. It's capitalcosm.substack.com, where you get early access, ad-free versions, and uncensored versions of all my videos, particularly the ones that warranted, obviously, before they, unlike the YouTube audience. So, and then at last, check out our partners at Pimbex, PIMBEX.com, for all of your gold and silver buying needs. All right, guys. Thanks for watching. I'll catch you in the next episode. Bye.
Thank you, Danny. Thumbs up.